Hello and welcome to my financial accounting YouTube channel. If you're watching this, you're probably in my section. So first of all, I miss you guys. I hope you're doing well. I hope you are safe and healthy. And although I can't see you, you will be seeing me, kinda sorta, because I am recording section videos for you guys. So the plan is to go through my normal slides, talk you through them, add in some notes, and then go through practice problems at the end. And I know since you're not in front of me, you can't ask questions as I go along, but you can pop into my virtual office hours. You can message me at any time as you know. So yeah, I'm really excited about this. This first video might be a little rough, but we will keep moving forward. And with all that in mind, let's get started. Okay, Chapter 11 is Current Liabilities and Payroll. So, what are current liabilities? Current liabilities are debts that will be paid out of current assets and are due within the year. So, within the year is the key phrase right here. Whenever you see current, that means within 1 year. And I think that was a question on your last exam. The three types of current liabilities that we'll be talking about are accounts payable, which you're all familiar with. Those are used for numerous transactions, mainly like buying things on account, all of that. The second is the current portion of long-term debt. So long-term debt, if you think of like a mortgage on a home, that could be for 15 years, 20 years, 30 years, and it's paid off in a series of installments. So the ones due within this year would be classified under current liabilities, and the rest of the long-term debt outstanding is classified under long-term debt. And the last type is short-term notes payable, which we'll talk about right now. Okay. A notes payable may be issued to purchase merchandise or other assets, and in that case it would be functioning like accounts payable, so you would debit your asset or whatever you're buying, and you would credit notes payable instead of accounts payable. It can also be used to satisfy an account payable created earlier, because as we know, whenever it's like a notes payable or a notes receivable, that's just a more formal commitment. So in this example, it says the company issued a 90-day 12% note for $1,000 for an overdue account. And the first thing we would do, so on December 1st, we're going to get rid of the accounts payable and create a notes payable. So we would debit accounts payable for $1,000 because that's overdue, they didn't pay it, and we're going to take that off our books. So it's normally a liability account, so we'd credit to increase, we're going to debit it to take it off our books, and then we're going to credit notes payable to create that new liability. So we're crediting notes payable for $1,000, and that's our first step. Our second step would be to pay off the note when it comes due. So when it's due after the 90 days, the first thing we do is debit notes payable for $1,000. So that's the full face value of the note. We are getting rid of that liability because we're paying it off. So we debit notes payable for $1,000. With notes payable, there's also an interest expense involved. So if we remember, we calculate interest as the face value of the note times the interest rate times the term divided by 360. So in this case, for the $30, it would be the face value of $1,000 times the interest rate of 12% times the term of 90 days divided by 360, and that gets us the $30 interest expense. So we debit interest expense for $30, and then we're going to credit cash for the full value we're paying off, so that is the $1,000 face value and the $30 interest expense. So we credit cash for $1,030. There's also a discounted note. So with a discounted note, the borrower receives the face value of the note less the discount. And the discount is very similar to interest. You calculate it as discount equals the face value times the discount rate instead of the interest rate times term divided by 360. And what the borrower is receiving is called the proceeds of the note. And proceeds is simply equal to face value minus the discount. And that's how much cash they're receiving. So if we look at this example, it says the company issued a $10,000 90-day 15% discounted note to the bank. So the first thing you're going to do is calculate the discount, and the discount is the face value of $10,000 times the discount rate of 15% times term 90 days divided by 360 is $375. So we calculate what the proceeds are because that is what you will receive. So the proceeds are the face value of $10,000 minus the discount of $375 is equal to $9,625. And that is the cash being received. So you're receiving cash of $9,625, so we're debiting cash to increase it. And then you're also implicitly paying the interest expense right now. So instead of receiving $10,000 up front and then paying interest for it later, you're only receiving $9,625 and you're paying the interest on it right now. So you debit interest expense for the amount of the discount, so that's $375, and you are going to credit notes payable for the full $10,000 because when it comes to term, you'll pay back the full $10,000 in cash, so that's basically paying for the cash you received and then paying the interest on top of it. So the difference between a discounted note and a regular note, with a regular notes payable, you're receiving the full face value up front and you pay back the face value plus interest, so you end up paying more, but you get the full amount up front. And then with a discounted note, you receive the face value less the discount, so you receive less up front, but you only have to pay back the face value, so the $10,000 here. There's no set rule for why you would choose one or the other. They're both fine. Just knowing the difference in how they're journalized is important. Okay, the main part of this chapter is payroll and payroll taxes. So I'm sure you're familiar with payroll, but payroll refers to the amount paid to employees for services they provide during a period. And we make a distinction between gross pay and net pay. Gross pay is the total earnings of an employee for a payroll period. So that is the hours they work times the wage they earn per hour. And that also includes overtime hours. So you would have like overtime pay times overtime hours. Net pay is total earnings less deductions, and that can include federal, state, and local income taxes, medical insurance, contributions to retirement, all sorts of stuff like that. And it's the amount the employee takes home. So it's important to know that net pay is equal to gross pay minus any and all deductions. Okay, so employees usually withhold a portion of employee earnings for payment of employees' federal income tax. So instead of the employee having to go and pay it themselves, the employer knows what they have to pay the employee, but then withholds a portion of that income and then pays the government for their employees. How much do they withhold depends on allowances they have. So the employee is granted an allowance, which is like a deduction, and that could be for whether you're single or married, whether you have dependents, so like children, all sorts of stuff like that. You don't need to know how this is figured out or anything. It's done using a withholding table that you can see in the book, and basically you determine your income tax based on your gross pay, so what income bracket you're in, and then any allowances you have. But in the context of like questions and how it'll be asked, they'll tell you how much is being withheld. You don't have to calculate it yourself. Okay, so FICA taxes are broken up into Social Security and Medicare, and those are basically like the most common deductions. So Social Security provides payments for retirees, survivors, and disability insurance, and it's 6% on all earnings. And then Medicare provides health insurance for senior citizens, and that's 1.5% on all earnings. So FICA tax in general is 7.5% on earnings. And you should know these percentages. Yes. Okay. So computing net pay. Gross earnings, again, is the total amount you earn. So that would just be your hours worked times the wage you earn. So in this case, if it's $1,000, we can say you earn $10 per hour and you worked 100 hours. So you get $1,000. And then your deductions. So federal income tax is determined via withholding table, so it would just give you that amount. So it's $157.90. Social Security tax is 6% on all earnings, so 6% times 1,000. Medicare is 1.5% on all earnings, so 1.5% times 1,000. So our total FICA taxes, so Social Security plus Medicare, is 60 plus 15. And then our total deductions is the federal income tax, Social Security tax, and Medicare tax. So $232.90 are deducted from gross earnings to get net pay of $767.10. So that is how you would compute it, but now we're going to show how you would journalize it. So accounting systems for payroll and taxes. You are going to do 2 journal entries, one for employees and one for employers. And it's kind of confusing because the employer is the one journalizing both entries because they're the company and it's their books that we're looking at, but it's 2 separate entries because one is for the employees and one is for the employer. And I'll go through it more and hopefully it makes sense. But if not, always you can ask me questions, email me questions, text me questions, ask at office hours, all of that. So this is for employees. This is the first entry you would do. What you're going to do is debit salaries expense for gross pay. You're going to credit all of the tax payables, so income taxes, Social Security, Medicare, all of that, credit tax payables, and you're going to credit salaries payable for net pay. So using the numbers we just found on the last slide, we are going to debit salaries expense, that's our first thing, debit salaries expense for gross pay. So looking at the last slide, gross pay was $1,000. So the total expense we're paying is $1,000, and that'll be broken up into taxes we have to pay and the actual amount we'll pay our employees. But that's the total amount we have to pay for employee earnings. Then we are going to credit all of our tax payables. So if we again look at the last slide, we have federal income tax, Social Security tax, and Medicare tax. So we credit employees federal income tax payable for $157.90. We credit Social Security tax payable for $60, and we credit Medicare tax payable for $15. So this is the second step. And then the third step is to credit salaries payable for net pay. So we calculated net pay as gross pay minus the deductions. So net pay was $767.10. So we're crediting salaries payable for $767.10, and that is the amount that we will pay to the employees when payroll is paid. So again, this is the employees entry because it's for their pay, but the employer is journalizing it. So the other entry you'll do is for the employer. So this is going to be the employer's entry. So this is recording and paying payroll taxes. So this is important. Payroll taxes are recorded as liabilities when payroll is paid to employees. This usually comes up a lot. It's not a liability until payroll is paid. So make sure you know that. And then also important to note is that employers must match FICA taxes. So whatever their employees pay, they also have to pay the same amount. They match it exactly. And they pay both federal and state unemployment taxes. So the employer entry is basically all of the taxes that the employer has to pay that are related to payroll. So what you're going to do is first, you're going to obviously figure out how much you have to pay for all these taxes. So Social Security and Medicare are going to match the employees' numbers. So it's going to match employee numbers. And then state unemployment tax and federal unemployment tax. Obviously, state varies by state, so you'll get a percentage for them to calculate it. And once you figure out all the taxes you owe, you'll get a total amount for it, and you're going to debit payroll tax expense for the total amount, and then you're going to credit all of your tax payables individually. And this is what the full journal entry will look like right here. And this, again, is your employer entry. So it's basically just handling all of the taxes payable and figuring out what your total payroll tax expense is associated with paying your employees. Okay, so now we have fringe benefits. This is sort of like an additional topic. Fringe benefits are benefits in addition to salary and wages, and these can include things like vacations, medical, retirement, all sorts of things like that. The main one we're going to talk about and focus on is pensions. So pensions are cash payments to retired employees, and there's two different types. There's defined contribution plans, where basically both the employer and the employee contribute. The employee might say, okay, I'm going to put 5% of my earnings into a retirement account, and the employer might match that dollar for dollar, so 100%. They might match it 50%. They might match it up to a cap, all sorts of things like that, but basically the main part is that both parties contribute. The other type of pension plan is a defined benefit plan, and that is when companies pay employees fixed annual pensions. And this is pretty rare because that's like a huge liability for the company. Usually you only see it in like state workers and stuff like that because, again, it's a huge liability. But those are the two types of pension plans. Then we have what's called contingent liabilities. So contingent liabilities are potential liabilities, keyword is potential, that may arise from past transactions only if certain events occur in the future, and that's why it's contingent. It's contingent on those certain events occurring in the future. And we categorize them different ways and record and disclose them differently based on that. So if the event in the liability is both probable, so it's likely to happen, and we can estimate it, so we have a specific figure, then we both record and disclose the liability because it is likely and we have a number for it. So we tell everyone what it is and then how much we think it'll be for. The second case is if it's probable, but it's not, we don't have an estimate for it. So you might not know the specific figure. So maybe you know that it's likely you're going to be sued, but you don't know if you're going to be sued for $1 million or $50 million. It depends on what the other party finds out, how lenient the judge is, all sorts of stuff like that. So in that case, you just disclose the liability. You don't record it because you don't have a specific number, but you let people know that it's likely going to happen. The third possibility is if it's reasonably possible. So you don't know, it's not certain, it's not like very likely, but it's reasonable, and then you don't have a specific number for it, you would still disclose that. And then if it is remote, that means there's like very little probability of it happening, you wouldn't even bother disclosing it because the probability is so low. So this is important. The only time you record it is if it's probable, so it's likely to occur, and you have a specific figure for it. So that's this one right here, is when you would record and disclose a contingent liability. Okay, so that covers the content. Now I finally have time to go through practice problems, so we're going to do a few of these so you are comfortable with content. Obviously, again, I'm not in front of you, but if you have questions on anything I do here, please just let me know. Okay, so this deals with a discounted note. So it says Rock & Co. issued a $40,000 120-day discounted note to Guarantee Bank, and the discount rate is 6%, and we're assuming a 360-day year. What are the cash proceeds to Rock & Co.? So if we remember, the proceeds are equal to the face value minus the discount. So first we have to calculate the discount. So the discount is equal to the face value of $40,000 times the discount rate of 6% times the term divided by 360. So it's 120 days divided by 360 is equal to $800. Then we calculate proceeds as the face value of $40,000 minus the discount of $800. So proceeds is equal to $39,200, and that should be C. Okay, this one is just a standard definition type one. So which of the following taxes would be deducted in determining employees' net pay? So for employees, we know we deduct federal income taxes, we deduct Social Security taxes, we deduct Medicare taxes, etc. We know Social Security taxes and Medicare taxes are classified together as FICA, so this is definitely true. And then FUTA and SUTA would be used in calculating the total payroll taxes for the employer, but the employee does not pay them. So the only one correct here is A, and that is FICA taxes. These two are used in the employer entry. So that D is a little bit tricky. All are correct. It's just A, FICA taxes for employees. If it had said the employer entry, then it would be all of them. Okay, this one's a little tricky. It tells us that the following totals from December were taken from the payroll register of company X. So we have salaries expense of $14,000, Social Security and Medicare taxes withheld of $1,050, income taxes withheld of $2,600, and retirement savings of $1,000. And it is asking us the entry to record the payment of net pay. Keyword here is payment. So I'm going to show you what it's asking. First thing you would do is figure out what the net pay would be. So we remember for our employee entry, it looks like this. This is the first step. We are going to debit salaries expense for gross pay. So we would do salaries expense is debited for $14,000. Then we have Social Security and Medicare taxes withheld. So those are FICA taxes payable for $1,050. So I'm just going to shorthand it. So FICA payable is $1,050. Then we have income taxes withheld. So that is income tax payable, again shorthand, for $2,600. And then we have retirement is also a deduction, so retirement payable for $1,000. And then we are going to credit salaries payable, which is equal to our net pay if we remember, for our gross pay of $14,000 minus our deductions. And if you do that, the $14,000 minus $1,050 minus $2,600 minus $1,000, you get that salaries payable is equal to $9,350. So now you know what net pay is, and this is what the original entry would look like, but it's asking you to record the payment of net pay. So the payment of net pay looks like this. When we're paying it out, that means we're paying cash to our employees, we're getting rid of the liability for it. So we are going to debit salaries payable for the $9,350 because that's the liability we had. That's how much we owe them in net pay that we're going to pay out to them and they're going to take home. we debit salaries payable for $9,350, and we would credit cash for that same amount because we're paying them. So this is what it's asking, the payment of net pay, and then which would it include? It would include a debit to salaries payable for $9,350. So a bit of a trick question, because you might think it's a credit to salaries payable for $9,350 because that would be what's right here, but it's asking for the payment. So instead it's going to be a debit to salaries payable because you're paying the salaries. You're paying net pay to your employees. And then last question. This one is kind of a common one you might see. So we're going to take it step by step. Long question. It says an employee receives an hourly wage of $15 with time and a half for all hours worked in excess of 40 hours during the week. So automatically that means they get overtime pay of time and a half. So that would mean their overtime pay is equal to their $15 regular rate times 1.5 is equal to $22.50 per hour overtime pay for all hours worked in excess of 40 hours during the week. And then it tells us payroll data for the current week are as follows. Hours worked were 48. Federal income tax withheld was $120. The Social Security tax rate is 6%. Medicare tax rate is 1.5%. State unemployment compensation tax is 3.4% on the first $7,000. Federal unemployment compensation tax is 0.8% on the first $7,000. And what is the net amount to be paid to the employee? So, first things first, we're going to calculate gross pay. And gross pay, if we remember, is simply hours worked, regular, times wage, regular, and then overtime hours worked times overtime pay. So gross pay in this week is going to be, so they worked 48 hours, it would be 40 hours of regular time times their $15 regular hourly rate. And then they worked 8 hours overtime times their $22.50 overtime rate. So gross pay is going to be $780. That's our first step. Our second step is determining deductions. So our deductions are going to be, first it just tells us that federal income tax withheld was $120. So it's going to be $120 for Fed income taxes. And then it is going to be 6% for Social Security taxes and 1.5% for Medicare taxes on our gross earnings. So it's going to be $780 times 0.06 for Social Security plus $780 times 0.0015. Just kidding, that's one too many. But, for Medicare. And the total deductions are going to be $178.50. This is bothering me. That's just going to be 0.015. There we go. So our net pay is going to be our gross pay of $780 minus our deductions of $178.50 equals $601.50, and that is going to be B. So, kind of a long problem, but it makes sense intuitively. Yes, so that is chapter 11. If you have any questions at all, obviously I know I'm not in front of you, so I can't answer them right now, but please send me follow-ups. You can text me, email me, FaceTime me, Zoom me, whatever works for you. Hope you have a great rest of your day.